You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the mid-year life insurance review for 2013. And on today's show, Current Assumption Universal Life with special guest Bobby Samuelson, executive editor of the Life Product Review.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. Of course, I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me, day 3 on our mid-year life review, Bobby Samuelson.
Glad to be here.
Bobby, first of all, I just kudos to your generation. You are the next group up coming up, and I mean, I'm telling you, you have intel to die for, okay?
Right.
And I so appreciate you and your
Thank
talent
you.
and your gifts.
Appreciate that.
And everybody watching knows who you are. And our former show, I mean, the shows we've had you on before are just killing it.
They're great, yeah.
They're huge, and we draw so much consumer traffic off that, which blows my mind. I want to talk today about Current Assumption. You know, buy term, invest the difference. E.F. Hutton, somebody back in the day in the 80s, decided to combine this on a platform, the same actuarial platform, and see if we can get investments and talk about, yesterday we talked about 12% IU or variable.
Yeah.
We were doing 12% UL back in the day in the 80s.
It's crazy.
It was crazy, but they told us no problem, even though the internal expenses on those contracts were between 500 and 600 basis points. But really, it's evolved. And Current Assumption UL. But I have a question for you right out of the get-go.
All right, shoot.
Now, we've talked about this a little off air. I'm trying to make it easy for consumers to understand Current Assumption UL. Is not that the same basic platform for Current Assumption UL that uses interest rates, indexes, and variable separate sub-accounts?
Yes.
Well, let's talk about, give me a little yin-yang of that.
So I totally agree with you. And I think people try to make life insurance complicated. Life insurance is really not that complicated. When you think about UL, right? The mechanical chassis for those three things is exactly the same. You put premium in, they take a policy load out, they pull out policy charges, and then you get an interest credit. Now that interest credit can either be stated by the insurance company, which is a Current Assumption UL, it can be linked to an index, equity index like S&P 500, which is indexed UL, or it can be invested into securities, which is VUL. But the mechanics are all exactly the same, which is policy charges out, interest credits in, all right? And the way you get something that earns an interest is to overpay for your coverage. So you've got to pay in excess for your versus premium charges, right? And then that grows and grows and grows, and in the end, you'll end up underpaying for your coverage because then your account value is deducted for the difference. So that's the mechanics, and it's all very simple. It's just money in and money out. And any good advisor should show a policy charge sheet so that clients can see the money going in and the money going out. And once you look at it, it makes perfect sense, and they all work mechanically the same.
I just want to go to this point. I mean, when we order not only the internal rate of return for death benefit and cash value on the proposal, but of course the policy expenses to show how the mechanics work. Interesting enough, about a year ago, the 401k regulations came online and introduced a new contract or tactic called 408B2, which we had to disclose all the expense loads in a 401k, whether it was admin, compliance, 404C, all the charges, the IRA charge, the internal expenses.
It's a lot.
And they didn't include, again this year, my gripe, they did not include the statement of additional information, which is another 90 basis points that they didn't talk about. I have no problem disclosing Current Assumption UL, whether you use the interest rate, index, or the separate account model. But what I do gripe about is, now that I've put all those numbers on, including the 90 basis point SII, my numbers look pretty good if I manage this for supplemental income. I mean, we can compete against some of these other expense load issues.
Yeah, sure.
The number one gripe in our industry is that we're so expensive, and I said, the policy has to be designed correctly, and I can mitigate the cost of insurance, which is the only thing they'll let me change in the proposal, right? We can mitigate those issues.
Yeah, I mean, to some degree, right? I mean, there are certain things we can't mitigate, and there are certain things we can. I mean, we can't change the carrier's profit to some degree, especially the way the carriers charge for profit now. You know, a lot of them, there's obviously the premium load, and then they also have a kind of a fixed charge for the first 10 years that's really designed to recapture a lot of their profits. So you can't really change that as much, but on COIs, I mean, look, that's where designing a policy the correct way, you can really basically minimize the death benefit, and then you have lower policy charges. And so I think when people say, you know, life insurance is really expensive, I don't know what their basis of comparison is, or even when they say agents make a really high commission. I mean, personally, I think agents get paid the wrong way, which is all up in the first year. But the overall commission in a life insurance contract versus, say, a 401k account managed for life, I mean, those things are basically the same. And so, if not less for life insurance than the 401k. So I think, again, printing out a policy charge page and looking at that, especially over the long run, looking at the IRRs like you talked about, you know, you kind of come to the conclusion that, yeah, I mean, in the early years they are expensive, don't get me wrong. That's the way they've been designed to recapture agent commission and carrier profit. But in the long run, they end up being okay. Now, the issue is a lot of products don't make it to the long run. Why is that? Well, agents want to come in and roll old policies over that are underperforming, or, you know, client doesn't want it anymore, didn't really understand what they bought. So there's a lot of reasons why policies basically aren't even given a chance, right? They don't even make it long enough to know whether or not it was actually a good deal. And I think that's the bigger problem with life insurance. People just don't understand what they bought. And if they understood what they bought, they know they have to hang on to it for a long time.
Bobby, I want to ask you a question. This is kind of a loaded one, but
It's fine.
Premium loads. I'm trying to understand, it can't be consumer centric, so why are they charging premium loads on current assumption anything?
Loads. You mean just
The front end load, percentage of my premium. Why is that?
So part of it's premium tax. Okay, so there are premium tax requirements in different states. So let's say 2% of that or so is premium tax. You know, the other issue is too, each pricing component in a product operates differently under different funding patterns. So let's say, for example, that you have a policy that you're paying a low-level lifetime premium for. Well, if you have a high load on that contract, it really doesn't matter that much, because even though it's taking maybe 8 or 10% of your premium out every day, you're not paying that much premium into it, especially in the early years, all right? Because you're using it for death benefit protection. So the dominant driver of performance is actually COI charges on that one. So COIs are kind of the heavy emphasis there. But if you do like an overfunded contract where you're putting a lot of money in up front, if the carrier is trying to make profit off of COIs and we're going to reduce the death benefit to minimize the COIs, the carrier's not going to be able to make their profit. So there's just kind of this intertwining of fixed policy charges, COIs, and premium loads, and that's why loads have to be there to balance that out across different funding patterns and product types.
Just for
Does
a
that make
minute.
sense?
Just for a minute, Bobby. I thought you were a home office defender.
No, it's
Oh
just
my
part
God.
of the pricing model.
We come back, we're going to talk more about current assumption UL with Bobby Samuelson right after the break.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Bobby Samuelson. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the backroom technician icon right on my Biz blog for the 30-day free trial offer for the best needs analysis and educational material that almost addresses every financial scenario out there. And just a heads up, before moving forward with anything we say on this show, always consult your tax advisor or legal counsel, as if they knew what I was talking about, as well as your compliance officer.
Yeah.
If you're FINRA licensed. And we are talking about current assumption UL, and I doubt very much if the fiduciary community has any clue on what we're talking about, although that's our job to educate them.
Right, yeah.
Now, Bobby, I'm just trying to understand and get a handle on this. If I'm suppressing the death benefit down to the DEFRA corridor and I'm still TAMRA compliant, okay, just to get all the
Acronyms out of the way.
acronyms out of the way. And I'm sitting there looking at I'm still getting dinged on the front end of my premium load. For some reason, I know you say it's profitability, but for some reason it seems like an excessive charge.
Yeah, I mean, think about what how a carrier's got to earn money on this. I mean, there are multiple different levers here, and there's obviously an investment spread they can apply, but that doesn't really always apply to VUL unless there's an explicit M&E charge or it's baked into the cost of funds. So you kind of have the spread profit, you have premium loads, you have fixed policy charges, then you have COIs, and all these things just operate with different variables. And so what happens is if you crimp them on their COI, if they have profit baked into COIs, and most companies do, then if you crimp them on that, they're going to have to charge you more on the load or more on the fixed charge up front.
Well, then why did they not do this at the front end? When we had VUL in the early 90s, we didn't see any of this.
Yeah, so I think what's happened is, you mentioned at the beginning of this that there's been some evolution here. And I think carriers have gotten a lot more savvy about how to build their policies. And so what you see really is policies that are specifically designed for accumulation and products that are specifically designed for current or for death benefit, and you call it indemnification. So what you see is that typically on these contracts, the accumulation contract might have a lower premium load and a higher fixed charge and more profit baked into the COIs because they know you're going to crimp those down. And so that mixture may equal, from a profitability standpoint, the same thing as if a company took a higher spread on the investment earnings, higher premium loads, and lower fixed charges and lower COIs on the death benefit product. So all they're doing is saying, how do we expect people to fund these contracts? And then we're going to build the policy accordingly. And by the way, if you try to fund an accumulation product for death benefit, it's not competitive. And if you try to fund a death benefit product for accumulation, it's not competitive either. Now, the only real difference between these two things is agent commission. If agent commission is a lot higher on one policy versus another one, you can bet that you're either going to have a higher premium load or a higher fixed fee up front. So that's kind of the only loose variable here, is if one pays a higher commission than the other one, you'll see higher policy charges.
Well, let's talk about this, because this is a yin and a yang. We're going to get into par whole life tomorrow, so let the battle begin.
Yeah.
But really, we talk about two sets of rates: cost of insurance, interest on current assumption interest rates.
Right.
They're always this debate of two sets of rates. I can't go to the client and tell him I have fixed costs here. I have a fixed premium load, I have a fixed administration charge, I have a fixed policy fee, but I don't have fixed COIs. I could drop and punt to my maximum contractual numbers. I also could do that on my guaranteed interest. Talk a little bit about because there's this protectionism from the carrier's point of view, and we just went through the worst interest rate volatility, and they survived it.
So I think there are two ways to look at this. One way is carrier is going to try to screw me by increasing COIs, and that's why life insurance is bad. I don't want to put words in the mouths of carriers, so forgive me. But I would argue that the primary reason why carriers have these two different rates, current and guaranteed, is not because they ever plan to change them. It's because the DEFRA and TAMRA corridors that you just talked about, NEC limits and definition of life insurance, making sure you qualify as a life insurance contract, those are all basically old school calculations that came around in the 80s based off of guaranteed COIs. So if a company could basically qualify correctly under TAMRA and DEFRA and guarantee the current COIs, I think most of them would be able to do it. So I think a lot of times you see these two rates in here, not because the carrier actually plans on charging them. The guaranteed interest, I think that's possible. You can definitely go to guaranteed interest. But guaranteed COIs are there primarily just to make sure that people can put a lot of money into these contracts.
Would that change if I went from guideline to
cash value.
CVAT?
Yeah, sure.
Okay, we'll talk a little about the difference.
But the MEC limits would stay based off.
Would they still stay the
that's right.
same?
That's where you end up with a problem. So that's kind of one angle is, hey, look, these aren't here because carriers are going to do it. They're here because in order to qualify to get people to fund the products flexibly, they have to have these higher COIs. It's basically, I don't want to say it's a bad regulation, but these are old school regulations applied to new school products. So that's first thing. Second thing is, look, if the carrier actually did change the COIs to guaranteed, and that has happened in the past. I mean, a company sells a block of business or whatever. I mean, stuff can happen. But the companies today, I don't think really intend to do that. But if they actually did change it, first of all, you would see it coming from a mile away. All right, it would not necessarily instantly go from current to guaranteed. And even if it did go from current to guaranteed, if the client has cash value in the contract, what are they going to do when it goes from current to guaranteed? They're going to surrender it, or they're going to 1035 or go do something else, right? So I don't view it like people look at the guaranteed side of the ledger and say, oh, this looks terrible. Well, that assumes that you fund the policy every year, even though policy charges are the guaranteed maximum. What client's going to do that? Nobody. So it's not, the guaranteed side of the ledger is not a real ledger. That, in any given year, right, those charges, but that would be current, 1 year guarantee, policy gets out. Now, if the client can't 1035 because they're uninsurable, then you're happy to have life insurance coverage at any cost, right? So I think people really overreact to this whole guaranteed COI issue, because if you actually look at the way policies work in the real world, unless you are funding that contract and keeping it with the guaranteed maximum COIs and they change it day one, it doesn't matter. And so that's my angle on that. I don't think it's that big of a deal.
Well, just remember this, and this is not a casual threat. if you do raise your guaranteed COIs, you will never see the light of day in the brokerage
We
community.
will find you.
We will find you.
And it can happen.
Oh,
I mean,
yeah. Remember, you can follow me on Twitter, Facebook, LinkedIn, or even email me at steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.